Welcome back to the show. I'm Ozbourne Foreman and this week has been super busy and we are changing it up once more. I know. I'm going to talk about the last week in the news, how that's impacted my stocks in my portfolio and how I track my monthly dividend income. And make sure to stay tuned to the end as I'm going to tell you which stock I've been selling out of as well. My current biggest position is actually Redrow, and currently I have around 366 shares, and in the future I plan on adding to this position. I'm looking to have around £2,000 to £2,500 in equity of this stock because I'm very bullish on the house builders and what that means for the UK economy. Well, on Thursday, Taylor Wimpey actually announced, which is another house builder in the UK, that they were diluting their share pool by selling something like 300 million new shares at around £1.32 each and raising a capital of around 552 million. This would be a bad thing for investors as they're seeing the amount of shares dilute, and since there's more of it, there's less of a demand for it. However, as a business strategy, I think this is quite ingenious. I think that they're going to look to buy up land for cheaper prices in the next coming years and therefore benefit from it in the long term. And personally, I would like if Redrow did something similar. However, I'm not going to complain about this as obviously they are holding the value of their share price. But all of the house builders in the UK have really strong cash positions, so it doesn't matter as much. National Grid, my utility holding in my portfolio, has announced that they were going to lose around 400 million in operating cash flow this year. And this was due to the rising amount of bad debt from the US, as well as a lower energy demand. And I think the bad debt is based on the fact that they are no longer trying to continue with their collections of the debts in America. So more citizens are defaulting on their loans, on their bills, and therefore, since they're not being chased up, they're kind of getting away from it for the time being. So I think it will all eventually catch up to them, but in light of this news, they have grown their dividend and announced a new one for August by around 2.6%, which isn't a massive deal as my National Grid position isn't too big at the moment, but it is something I look to expand on in the future and it is one of my most defensive stocks. And in fact, they've been one of the top performers this week with a return on capital of around 8%, which is impressive for National Grid to say the least. TSCO, or the Tractor Supply Company, has actually announced that they were going to continue selling off their assets, and what they've been doing over the last few years is selling off their businesses to other companies in areas that were less profitable and that they weren't holding market share with. These locations such as Thailand and Malaysia in March, and now recently they've announced that they are selling their Polish division to their competitors so that they can get out of that market and focus on their current markets, which I believe are Hungary, Slovakia, Czech Republic, Ireland, and the UK. And so I personally see this as a great improvement and move for the company. I think that I'd rather invest in a business that is smaller, more niched, but has greater operating profits than that of a big dinosaur company that's globally diverse and that's barely making that much money, just enough to keep going. I think that they can re-evaluate their business plan after selling off all of these assets and then specifically targeting new sectors, and it gives them more growth potential in the future. And whilst my position is probably one of the smallest in the portfolio, I will add to this in future. Just at the moment, I'm trying to calibrate. I want to go for more higher risk assets, and Tesco isn't really one of them. And so I will look to increase that once there's more stability in the market. Lately, I've been watching the Bank of England's quantitative easing asset purchases, which is where they buy government-lended treasuries and prop up the economy basically. And in recent news, you would have seen that they announced another 100 billion of quantitative easing to be done. At the time of this, the stock market had dipped ever so slightly, but now we're in the positive, and on Friday, I think the FTSE 100 had rallied around 1.4%. However, currently they have around 745 billion outstanding quantitative easing assets since 2009, and I think it's getting to quite dangerous levels. Recently on the news, they announced that we had now borrowed more than we could earn in GDP, and following other countries such as the US and Japan. I don't see this as too much of an issue, but it is something alarming that our debt is increasing, and whilst this may not impact us, it may impact the generations below us as they may have to pay more taxes in the future. Ashtead Group, one of my positions, has also announced their dividend, and it came to a surprise to investors, as a lot of people had thought that they would be suspending it or cutting it. And this is because they lease construction equipment to house builders and construction companies, and therefore you'd think, since most of the construction sites have been shut, that they wouldn't really be earning as much. Well, their leases typically last longer than a few weeks, and they might have it for a year, couple of years, so these companies are still paying and they're still getting some cash flow. But they didn't grow it by as much as usual, known by the whopping increase of 1.6%. I think this was reflected in investor sentiment, as we had all anticipated that it probably was going to get suspended, and then you'd seen a double-digit rally in one day. I think it was Tuesday, by around 14%. Which is a bit annoying because I wish I had a little bit more in the position, but it's still good news, and it means that they are willing to continue paying their dividend even in tough times. And in fact, Ashtead Group is going to be one of my top 5 holdings in the future. I just don't feel like it's worth buying into right now. And if you're interested in seeing my portfolio develop each and every week and seeing how my journey as a UK investor goes, with the ups and downs of the market volatility, then please consider subscribing, as currently only 60% of the people watching this video are not subscribed. Thank you. So far, since creating this portfolio in April, I've only received 3 of the 7x dividend stocks that I have passed through. People have been asking me, like, Oz, how do you track your monthly dividend income? Like, where does it go? How do you keep on top of it? Because it's quite overwhelming. It does seem overwhelming at first, and that's why the other day I created a video on how I track my dividend income. It was a spreadsheet. If you're interested in that video, click the card at the top right of the video. But I wanted to go more into depth about it, as well as continue with my portfolio update. And since I've received 3 dividends so far, and it's the 3rd month, which is about reasonable, I wanted to track my dividend growth, since it is a dividend growth portfolio. And so what I've been doing is looking at my activity feed on Freetrade and just tallying up all of the dividends. Since I have limited holdings in my portfolio, there's going to be less of them each and every month. If this is an issue for you though, what you can do is each month Freetrade releases a statement, and a lot of brokers do this across the world. And on that statement, it will say dividend income, at which point you take that sum, put it into the spreadsheet, which I have, and what the spreadsheet will have is that, right, I've received in June 2020 this amount of income, which will be around £18 for me currently, but there are a few more to come. And then I'll add that up each and every month, and hopefully we should see a steady increase over the period, which will start to compound more and more as I receive more in dividends. Although I don't expect it, for the first few months, I expect it to be very volatile, as obviously half of my companies have suspended their dividends. And on the spreadsheet I've created as well, I've got currently a yield on cost, which means if I bought all of my positions in the portfolio right now, I'd have a yield of roughly 6%, but this is assuming that they don't grow their dividends anymore, no one suspends them, so obviously Aviva and Redrow take up 2 large positions and would be paying a higher dividend income, and currently they're not. But it is nice to think about in mind, because that is definitely a higher dividend income than anticipated, which might even be seen as high risk. But I do think it's fair to assume that Aviva and Redrow will continue to be paying their dividend in the next year, or maybe even at the end of this year. And actually, speaking of Aviva, you would have noticed that I've increased my position with them. And in fact, I've bought 123 more shares of this company. And you may have seen recently my video comparing Aviva and Legal & General. And while it's partially related to that, I think that Aviva will continue down with its slimming process, and therefore see better returns of that than Legal & General, for example. Currently owning these stocks, I didn't really have much diversification, but what I am doing is eagerly waiting until August, which is typically when they announce their dividend. So in August, hopefully I'll find out whether they plan to resume their dividend or not. If they don't, then it might present a good buying opportunity to get more shares of Aviva, and I'm quite happy with my position currently. But if they don't announce it, then I might be buying more. But for the time being, I'm probably not going to add too much more. I've got 500 shares. I could add another 100 perhaps, but I'm just going to hold off for the time being. Remember to stay hydrated. I am really thirsty. But since I have bought more shares, obviously, my average share price is £2.53, which I think is still reasonable. And in the next 1 to 3 years, I could see this price being around £4-5 a share. And certainly I see this as a great return in the long term. I've also been adding to other holdings such as Redrow, Sage, Games Workshop and Shell. Shell is an interesting one because obviously I've not spoke too much about it on this channel recently. but currently their price has dipped below my average buy price, so I bought a little bit more into it. I made it so that my total equity in this position was £950, so that I could obviously see at a glance, so much simpler, so that I could just know, right, okay, it's currently at £990, right, so I've made about £40, etc. So that was the idea there. I bought into that to average it down slightly and also just even out my position more. I don't plan on buying much more of this in the future, if at all. I think I'm overexposed to the energy sector and I don't want to rely too heavily on it. As for Sage, I do think it is at a fair price currently, and I would buy it at this price. I think it is reasonable, but I want to go for higher risk. I think you've got to calibrate your risk tolerance at this point in the market. And currently, whilst Sage is trading at a fair price, and in the long term it will surely be a great deal, I think I can get better returns with that of other companies, such as Redrow, Games Workshop, and perhaps Ashtead Group as well. As with Redrow and Games Workshop, they're my two portfolio positions that are from the FTSE 250, which are more exposed to the domestic UK economy. Whilst yes, Games Workshop is globally diverse and won't be impacted as much by Brexit and the potential chance of having a soft deal, Redrow will certainly benefit from this. And I think that I could see very strong returns, hence it being the strongest position in my portfolio, because I'm very bullish on Brexit. I've also been doing some selling, as I mentioned at the start of the video, and I had been selling out of my Legal and General shares. I still think this is a great investment. I'm not bashing it. I feel that Aviva can outperform that of Legal and General in the long term. And to be honest, I think Legal and General is at a decent price. You could buy it now, you'd see great returns in the future. Personally, that's what I think. But I think Aviva is a little bit more discounted, and I think people aren't expecting them to start paying their dividend in August. And therefore I've been transferring out of that investment into Aviva. But what I will be doing is likely selling down, liquidating the rest of my Legal and General positions, and then reinvesting that elsewhere into the portfolio, such as Redrow, Games Workshop, Ashtead Group, etc. There's many things that I'm looking at, perhaps even some more defensive stocks. But there's no point me selling out now and holding into cash, because I'm going to miss out on the whole market volatility, and being out of the market is probably more risky. Currently, about 1.6% of my portfolio is in cash. And in fact, you'll notice that from last week, my portfolio has gone up by around £600 to £700. You might think, well, that's surprising. The market hasn't really seen that much volatility. I mean, rallying. And this is very true, actually. This is mainly because I've been depositing more. And this week I've deposited something like £625. Because at the time I saw great opportunities just to buy in for the long term and get more positions, strengthen out my positions, as some of them are spread a little bit too thin. I definitely wanted to buy more into Redrow, which I've been doing. And I think that over the long term, these positions will benefit. So I'm just trying to move more of my cash from my bank account. It's just sitting there doing nothing, not being a productive asset, into these dividend stocks or growth stocks. Interestingly, since we started the portfolio at around April 7th, we've actually underperformed the market as a whole. And that's with returns of roughly 8% on my portfolio since I've started investing. And the FTSE 100 has had around 10% and the FTSE 250 has had around 13%. However, this is not too accurately tracked. And this is on my spreadsheet where I also track my dividends. As you can see, I'm going to show you the screen here. It's based on whatever the share price was at that time. And that's assuming that I invested into all of my stocks at that time to see a return greater than that. And this also has to account for not reinvesting dividends and such. So yeah, it's likely very incorrect, as it doesn't account for the fact that I've deposited over the period rather than just buying all at a lump sum up front. But it is nice to see. At this rate, I am underperforming the market, but in the future, I should improve and do better. I think this is mainly because Aviva, Legal and General, Redrow are all stocks dragging the portfolio down at the time being. And so in future, this should improve. Make sure to stay tuned, because on Monday at 5 PM, I'm going to be talking about stocks I'm buying if there is a second wave of the pandemic. So make sure to stay tuned, click the subscribe button. Thank you. This is the Ozbourne Foreman Show. Really cheesy, I know. Thank you for watching. Have a good afternoon.